我都不好意思说我消费降级。就我以前的消费，
I feel a bit embarrassed to say that I've downgraded my spending, even though I never really spent that much before. I used to shop on JD, and now when I think about it, that feels a little luxurious. Last year, I was still using Taobao, which felt a bit high-end. But this year, I've started using Pinduoduo. I bought something for 9.9 yuan, but when I see something for 9.8 yuan, I'll quickly return it to buy the cheaper one. Now, whenever I open Pinduoduo, I compare prices across stores. You can save a few cents here and there. Some internet users have pointed out the number of bars has dropped by 65%, and the number of KTV venues has fallen from 150,000 at its peak to just 40,000 now. People's entertainment expenses are shrinking. It's not that they don't want to spend money, but that they can't afford to. Nobody dislikes a lively atmosphere, but it's simply too expensive now. This is the real consumer winter we should be concerned about, so we need to save more money. Other users are puzzled, as the national data shows GDP continuing to rise. Why then do most people feel increasingly poorer? What's the situation now?
2025年我们到底变得更穷还是更富？
In 2025, are we getting richer or poorer? I'll give you the conclusion first. In 2025, we've become poorer. On one hand, purchasing power has declined, and wealth is shrinking. On the other hand, opportunities to make money has become extremely scarce. Across all industries, we're seeing the disappearance of market growth and the fading of the benefits that came with the times.
Analysts have pointed out that China's economy is facing an unprecedented deep crisis, primarily due to 5 factors. First, the collapse of public confidence. From the perspective of consumer confidence, the main economic entities in China are experiencing a psychological deflation. The optimistic expectations, shaped by years of rapid growth, have been completely shattered by recent impacts from the pandemic, regulatory storms, and uncertainty about the future. This has led to a widespread cautious and even pessimistic sentiment. Saving money has replaced spending as the new normal. In 2022, national household deposits surged by nearly 18 trillion yuan, setting a historical record. In the first quarter of 2023, they increased by nearly 10 trillion yuan. In stark contrast to the retaliatory consumption seen in Western countries after reopening, Chinese consumers have chosen retaliatory saving. Many people have used their savings to pay off loans in advance, rather than increasing consumption. The Consumer Sentiment Index has dropped to a low point and remains at its lowest level in 20 years. The Federal Reserve's Research Department has pointed out that the optimism of urban households in China regarding future income has dropped to a historic level. This decline is partly due to the long-term impact of lockdowns and layoffs on family finances, and partly due to the difficulties faced by the younger generation in finding jobs, leading to the collapse of confidence about their future prospects. Young people, traditionally the main consumers, now find themselves having to lie flat and cut back on spending. The unprecedented wave of highly educated unemployment has left nearly half of today's university graduates relying on their parents, with disposable income growth becoming a distant dream. In 2023, the government's handling of youth unemployment data further fueled social anxiety and distrust regarding employment prospects. Additionally, the middle class has also entered a wait-and-see mode to protect itself. After setbacks in both housing and stock markets, middle-class families have seen significant damage to their balance sheets. To prevent further financial deterioration, they're more inclined to reduce consumption and increase savings. Spending on education, travel, and luxury goods, which were once popular, has sharply decreased, with consumption downgrade becoming a common term. Media reports indicate that many white-collar workers have started to tighten their belts, replacing the mentality of buy now, pay later with a mindset of saving wherever possible. The corporate sector, meanwhile, has exhibited unprecedented caution and pessimism. The confidence index of private entrepreneurs has dropped to a historic low. Due to uncertainty, they prefer to delay investment and hold on to cash, rather than expand production. Since 2022, private investment growth has nearly stagnated, and many regions have seen business owners either flee or relocate. What's more concerning is that some companies, in anticipation of deflation, have opted to lower prices, reduce inventory, and even sell at a loss, which has further spread deflationary pressures across the economy. A survey of 300 business executives shows that in 2024, the growth rate of labor costs has dropped to its lowest level since the pandemic, and businesses are extremely cautious about expanding their workforce. When businesses are unwilling to raise wages, unwilling to invest, individuals are hesitant to spend, and the government refrains from increasing debt, society falls into a collective contraction mindset. This is the typical feature of deflationary psychology. As analyzed by Tsinghua University's Financial Research Center, China has entered a deflationary dilemma, akin to an island economy where money is becoming harder to earn and people are increasingly unwilling to spend. Everyone is holding tight to their wallets, resulting in lower demand and a colder economy. A series of drastic changes have ultimately confirmed the public's pessimistic expectations. Once this pessimistic sentiment becomes entrenched, even if the government pumps money into the economy, it is difficult to change people's behavior patterns, turning deflation into a long-term trap. Second, the paralysis of the debt system. From the perspective of debt structure, China's high leverage trap has made traditional macroeconomic stimulus policies increasingly ineffective, even counterproductive. After years of a credit boom, China's total debt has reached nearly 3 times its GDP and continues to rise rapidly. By the end of 2024, the broad credit balance is expected to reach 408.3 trillion yuan, or 303% of GDP. If the statistical standards are adjusted, it could be closer to 310%. This means that for every additional 1 yuan of GDP, over 5 yuan of debt is required to support it, and compared to pre-pandemic levels, credit efficiency has been halved. In terms of household debt, driven by decades of a real estate bubble, Chinese household loans grew by more than 25% annually from 2009 until before the pandemic, with household debt soaring to 62% of GDP. By 2023, household debt was equivalent to 115% of disposable income, with mortgages making up half of the total debt, about $6 trillion, which is roughly 1/3 of GDP. Corporate debt is similarly large, especially for property developers and state-owned enterprises, which carry massive amounts of debt, with credit risks constantly emerging. Local government hidden debts have also become a deep-seated issue. According to the International Monetary Fund, by the end of 2023, local government financing platform debts in China reached 60 trillion yuan, accounting for nearly 48% of GDP. The direct consequence of this high debt is that traditional monetary easing and fiscal stimulus may even exacerbate deflation. Since the end of 2023, the People's Bank of China has cut interest rates multiple times and injected liquidity into the economy, but the results have been minimal. This is due to a lack of credit demand, with funds accumulating within the banking system but failing to flow into the real economy. Essentially, the money cannot be released. Meanwhile, local finances are stretched thin, forcing governments to cut expenditures. Many regions have reduced public servant salaries, delayed payments for projects, and borrowed to pay off debts, which in turn has drained liquidity from the real economy and increased deflationary pressure. Local government debt, due to the real estate downturn, has caused a sharp reduction in revenue, and borrowing capacity has reached its limit. The government dares not return to the old path of using debt to fund infrastructure projects because it was excessive stimulus in the past that led to today's massive debt burden. As a result, under the constraints of the debt trap, traditional monetary and fiscal policy tools are no longer effective. Third, the complete collapse of the real estate sector. From the perspective of the real estate cycle, China seems to be experiencing a long-term recession following the bursting of the bubble. Real estate has long been a gray rhino for China's economy, contributing about 1/4 of GDP at its peak, over 80% of household wealth, and a significant source of local government revenue. However, since the authorities tightened financing in 2021, China's real estate market has entered a deep winter. The wave of developer defaults, widespread unfinished buildings, and the collapse of consumer confidence in home purchasing have all contributed to a structural decline in the sector. Property prices have fallen sharply in many regions, with prices in some small towns, formerly wealthy homeowners, have rapidly fallen into poverty, and wealth shrinkage has become a widespread phenomenon. Over 70% of Chinese household assets are held in real estate. The sharp decline in housing prices has made residents feel suddenly poorer, causing them to tighten their belts. This is one of the key reasons for the sluggish consumption. At the same time, the financial credit system established during the real estate boom has been severely impacted. Local governments have lost land-based fiscal revenue, while banks are facing increasing risks from bad loans. Home buyers, wary of the risks associated with unfinished buildings, are reluctant to enter the market, leading to a slump in new home sales. Despite the central bank lowering mortgage rates to historically low levels and relaxing purchasing restrictions to stimulate the market, people have found that this time is different. The policy loosening has not resulted in a rebound in transactions, and consumer confidence has been severely damaged. Central bank surveys show that the population of families expecting housing prices to rise has dropped to a historic low. With the collapse of the myth that housing prices always rise, the era of excessive consumption and high-level property speculation has come to an end. Real estate is no longer the driving force for domestic demand. Instead, the risk from banks and local finances, which could collapse at any time, are looming. The long-term cooling of the real estate sector is bound to weaken residents' consumption tendencies and willingness to borrow. Fourth, the collapse of the population structure. From the perspective of population structure, aging and low birth rates are severely weakening China's domestic demand potential. The country is rapidly entering a society where it will grow old before it becomes rich. The proportion of the working age population has been declining since its peak in 2010, while the proportion of people aged 65 and above continues to rise, and it's expected to soar from about 13% in 2021 to 30% by 2050. The disappearance of the demographic dividend means a sharp decline in both consumption and investment demand. At the same time, the increasing proportion of elderly people leads to a lower consumption tendency and a higher savings rate, further intensifying deflationary pressures. The phenomenon of low birth rates is becoming more pronounced. In 2022, China's birth rate dropped to 6.8 per thousand, marking a historical low. Despite the government's strong push for marriage and childbirth, the results have yielded little success due to high childcare costs and changing attitudes among young people. In terms of labor supply, a sharp decline is expected by the mid to late 2030s. Over the next decade, China's largest age group, those aged 50 to 60, comprising about 300 million people, will largely exit the labor market. This is equivalent to the entire population of the United States retiring, leading to a sharp increase in pension and healthcare burdens. The Chinese Academy of Sciences predicts that by 2035, the country's pension reserves will be exhausted, and at that point, the younger generation will need to support 4 elderly individuals, further straining household consumption capacity. The collapse of the population structure will become a fundamental factor in continuously suppressing total demand for the next few decades. Fifth, the failure of policy regulation. From the perspective of institutional flaws and policy inefficiency, certain characteristics of China's economic system are actually deepening the deflationary trap. The first issue is the delayed and inadequate policy response. In the face of this deflationary situation, the decision-makers' initial reactions were slow, and they even lacked sufficient understanding. According to a report by the Wall Street Journal, Xi Jinping once asked advisors internally, "What's wrong with deflation? Isn't it good when things become cheaper?" This ignorance indicates that the leadership severely underestimated the systemic risks of deflation, missing the window of opportunity for preventative action. When deflationary pressures fully emerged, the policy response remained cautious. Monetary easing was limited in scope, and fiscal stimulus was hesitant, with more focus on rhetoric and regional measures rather than substantial nationwide actions. It was not until the second half of 2023 that former central bank governor Yi Gang made a rare public statement, acknowledging the need to focus on preventing deflationary pressures and calling for more proactive fiscal and monetary policies. However, so far, the government has not deviated from its established path. The policy approach remains rooted in traditional industrial policies that encourage production, rather than directly stimulating demand through expanded government public service spending or consumer subsidies. This reflects policy inertia and rigidity. The government is more accustomed to building infrastructure, laying roads, and launching projects, but is unwilling or unable to directly place money into the pockets of ordinary citizens. Since the founding of the Chinese Communist Party, there has never been a plan to establish a comprehensive social welfare system. In fact, the government has consistently taken a highly cautious and even antagonistic stance towards social welfare. As a result, when the government needs to use welfare to shift consumer expectations, there's no clear understanding of how to proceed, and a lack of well-established mechanism for distributing welfare. Another issue is data concealment and lack of transparency. Youth unemployment data has been suspended, local fiscal risks have been deliberately ignored, and the term deflation is conspicuously absent from official documents. This indifferent and evasive attitude towards problems has undermined confidence in the government's ability to resolve these issues. Nomura Securities chief China economist Lu Ting has said that the increasing ability of macroeconomic data will further weaken global investors' confidence in China. When problems are concealed and the policy-making process lacks transparency and oversight, it becomes difficult to correct courses in a timely manner. This institutional flaw has led to a shift in governance logic, from focusing solely on maintaining growth to prioritizing stability above all else. To maintain stable employment data, the government would rather not publish the true unemployment figures. To preserve the surface stability of the housing market, it has hesitated to allow high-debt property developers to exit completely, resulting in a deepening of economic problems. The Chinese Communist Party's system lacks a mechanism for self-correction, causing many policies to continue without revisiting them until they hit a wall, repeatedly missing opportunities for reform. Under the guiding principle of prioritizing stability, the policy focus is on short-term surface stability flexibility, which in the long run depletes the space for necessary adjustments and exacerbates the persistence of the deflationary trap. In addition to internal factors, the external economic environment in which China operates has also undergone profound changes, making it increasingly difficult for the country to gain inflationary momentum from the global economy. In the past, China has often generated economic momentum through large-scale exports and foreign capital inflows, injecting inflation into the domestic economy. However, today, the global demand and supply dynamics have evolved in a way that is unfavorable to China. The external environment not only fails to provide China with inflationary support, but in some areas has even further reinforced the deflationary tendencies. First, the global shutdown in demand and the reorganization of trade patterns have weakened China's export momentum. From 2020 to 2022, extraordinary stimulus measures in developed countries sparked a consumer boom, which briefly boosted China's exports. However, by 2023, the tightening in Europe and the US, and consumption shifting back to the service sector, global demand for Chinese products has significantly decreased. After high growth in 2021 and 22, China's export figures stagnated in 2023, and some months even saw negative year-on-year growth. For example, in the US, China's exports fell by over 30% year-on-year in 2023. Although exports to the region grew, they could not offset the losses from the US and European markets. In addition, the period of global high inflation has passed, with major central banks tightening monetary policies, which has suppressed import demand. Exports had long been a major driver of China's economic growth and the basis for price increases in the manufacturing sector. When external demand was strong, domestic prices also rose. Now, with weak exports and underutilized manufacturing capacity, prices naturally decline, exacerbating deflationary pressures and further contributing to a drop in the producer price index. A deeper underlying reason is the trend of supply chain diversification. In recent years, driven by geopolitical factors and cost considerations, companies in the US, Europe, and Japan have accelerated the relocation of part of their production outside China. Countries like Vietnam, India, and Mexico have become key destinations for these relocations, with some orders no longer coming to China, and China's global market share is gradually being eroded. Companies such as Nike and Apple, for example, have shifted some of their production capacity to Southeast Asia. A report by Goldman Sachs indicates that Vietnam's export growth to the US has far outpaced that of China. If this trend continues, China's export growth will come to an end, and without the support of export-driven growth, China is more likely to fall into low growth and low inflation due to insufficient domestic demand. One notable data point is that China's foreign trade surplus reached an unprecedented size from 2023 to 2024, reaching $823 billion in 2023 and increasing to $992 billion in 2024, about 5.6% of GDP. On the surface, China still seems to be experiencing export growth, but it is important to note that this is mainly due to a more significant decline in imports, reflecting weak domestic demand and the temporary impact of export price competitiveness. This is also the reason why the Chinese Communist Party continues to manipulate statistics, making it appear that GDP is still growing. However, a massive trade surplus is not a sustainable solution, especially when trade tensions escalate and China's trade environment deteriorates. Not only will exports struggle to contribute to growth, but the surplus may narrow or even turn into a deficit, which will also bring about a tightening effect, another significant hidden risk. Overall, the combination of 5 irreconcilable factors, coupled with the rapid changes in the external environment, signals the end of China's 3 decades of economic prosperity, driven by real estate and debt. China is likely to face a structural deflationary period lasting up to 30 years, with long-term economic decline just beginning.